They told you it was safe. They told you it was the smart money. They told you that if you just bought the haystack, you did not need to look for the needle. For the last 15 years, financial advisors, banks, and YouTube gurus have sung the same lullaby. Just put your money in an index fund. Buy the S&P 500, set it and forget it. It sounds perfect, does it not? A guaranteed path to wealth built on the back of the American economy. But what if I told you that this safety is a hallucination? What if the very thing that makes passive investing feel safe, the fact that everyone is doing it, is exactly what makes it a ticking time bomb strapped to your 401k? This is not about a market correction. This is not about inflation eating 3% of your paycheck or the price of eggs going up. This is about the fundamental machinery of the global financial system breaking down because we stopped doing the one thing a market is supposed to do: think. We are currently living through the greatest misallocation of capital in human history. Michael Burry, the man who stared into the abyss of the 2008 housing market when everyone else was partying, has sent up a flare. He is warning that index funds and ETFs are the new CDOs. He is warning that we have built a tower of debt and derivatives on a foundation that does not actually exist. If you have a job, a pension, or a savings account, you are unknowingly sitting at a poker table where the dealer has already left the building. Before we peel back the skin of this financial monster, I need to know who is in the room with us. Where are you watching from? Drop your flag or your city in the comments below. We are building a community that values the unfiltered truth over comfortable lies. If you want to survive the wealth transfer that is coming, hit that subscribe button right now. Let us get into it. To understand the trap we are in today, we have to look at the trap we stepped into yesterday. Let us rewind to 2007. The housing market was booming. It was invincible. The narrative was simple. Housing prices never go down nationwide. It was accepted wisdom. It was taught in schools. It was the bedrock of the middle-class dream. Because of this belief, Wall Street created complex financial products called CDOs, collateralized debt obligations. Essentially, they took thousands of mortgages, some good, most garbage, bundled them together into a massive pile and sold slices of that pile to investors. The investors did not look at the individual loans. They did not check if the homeowner had a job. They did not check the credit score. They just bought the bundle because the rating agencies stamped it AAA. They bought the system, not the asset. Does that sound familiar? Because right now, millions of people are logging into their brokerage accounts and buying the S&P 500 ETF. They are not looking at the balance sheet of the 498th company in the index. They are not analyzing the debt-to-equity ratio of the top 10 companies. They are buying the bundle. They are buying the system, not the asset. In 2008, Michael Burry saw that the mortgages inside the CDOs were toxic. He realized that the price of the bond had nothing to do with the value of the houses. The price was artificially high because everyone was buying. It was a bubble of liquidity, not a reflection of reality. Today, Burry is pointing at the ETF market and screaming the same warning. When you buy an index fund, you are blindly funneling capital into the largest companies simply because they are large. The more money flows in, the higher their stock price goes. The higher the price goes, the more they weigh in the index. The more they weigh, the more money they receive from the next person buying the index. It is a self-fulfilling prophecy, a feedback loop of blind greed.
In 2008, the artificial demand for mortgages encouraged banks to lend money to people who could not pay it back. It created a moral hazard. Lenders did not care about risk because they could just sell the loan to a bundle. Today, the artificial demand for stocks via index funds has encouraged corporations to stop innovating and start engineering. Why invest in R&D when you can just borrow cheap money, buy back your own stock, pump the price, and get automatically bought by millions of passive index funds? The CEOs do not care about long-term value. They care about being included in the bundle. Sound familiar? It is the exact same mechanic. Separation of price from value. In the mid-2000s, there was a term called ninja loans. No income, no job or assets. Banks were giving $500,000 loans to strippers and strawberry pickers. Why? Because the system needed product to bundle into those CDOs. The demand for the bundle drove the creation of bad loans. Today, we have zombie companies.
These are companies that do not earn enough profit to cover the interest on their debt. In a rational market, they would go bankrupt. They would be eaten by competitors. But in our passive investing trap, they stay alive. Why? Because they are in the index. Every time you buy the SPY or the VOO, you are indiscriminately sending cash to these zombie companies, keeping them on life support, preventing the creative destruction that capitalism requires. You are funding the very inefficiency that is killing the economy's productivity. The housing bubble burst when the teaser rates expired and the homeowners could not pay. The liquidity dried up. When people tried to sell their CDOs, they realized there were no buyers. The market went no bid. That is the nightmare scenario we face today. The index fund bubble is not driven by teaser rates. It is driven by the demographics of the baby boomers and the habit of automatic payroll deductions. Every 2 weeks, billions of dollars are blindly thrown into the market. But what happens when that generation retires? What happens when they stop buying and start selling? What happens when the flows reverse? In 2008, the banks stopped lending to each other because they did not know who was holding the toxic garbage. Trust evaporated. Today, the risk is that we will not know the true price of anything because we have not actually priced a stock in 10 years. We have just inflated it. We have confused expensive with healthy. Sound familiar? We are walking the exact same path, but this time, the casino is bigger, the leverage is higher, and the exit doors are smaller.
You might be thinking, okay, but stocks are liquid. I can sell my Apple shares in a second. Real estate is hard to sell. Stocks are easy. That is the difference. And that right there is the fatal mistake. That is the illusion. We need to talk about the primary mechanism that turns this from a bad investment strategy into a systemic catastrophe. It is called the liquidity paradox. Here is the twist. You think you own stocks. You think that when you buy an ETF, the fund manager takes your money and goes out to the market to buy the shares of the companies. In many cases, that is true. But in the dark corners of the financial system, especially with synthetic ETFs and high-frequency trading, that is not what is happening. The market has become hollow. In the past, active managers, people who study balance sheets, set the prices. Passive investors were just free riders. They tagged along. But today, passive investors are the market. They are the whale. If 50% of the market is passive and they never sell and they never analyze, then who is setting the price? The price is being set by a tiny minority of high-frequency trading algorithms and speculative day traders. The tail is wagging the dog. The price of the S&P 500 is being dictated by the marginal buyer, while the massive bulk of the iceberg sits underwater, unvalued, and purely theoretical. Michael Burry calls this the theater of liquidity. It looks like there is a lot of water in the pool, but it is actually just a thin layer of water over a block of concrete. As long as everyone stays in the pool, it feels fine. But the moment someone pulls the plug, the moment a panic starts, that thin layer of water evaporates instantly. And the receipt, the proof that this system is rigged against you, it is hidden in the fine print of the authorized participants, the shadowy middlemen who create and redeem ETF shares. They have an incentive to keep the music playing, but they have zero obligation to catch you when you fall. The receipt is wilder than you think.
Let us rip the hood off this engine and look at the gears grinding together. We need to simplify the index fund liquidity paradox because this is the specific mechanism that will freeze your assets. Imagine a movie theater. This theater represents the stock market. The seats in the theater represent the stocks. The people sitting in the seats are the investors, you, me, pension funds. The door to get in is massive. It is a barn door. It is easy to enter. You can download an app and buy stock in 30 seconds. Now, imagine that 90% of the people in that theater are handcuffed to their seats. These are the passive investors. They are programmed to sit there. They do not react to the movie. Good movie, bad movie. They sit. The price of the ticket to get into this theater is determined by the 10% of people who are not handcuffed. They are running around, screaming, buying and selling tickets from each other. The price of the ticket skyrockets because everyone wants to be in the winning theater. But here is the mechanics of the crash. The exit door is the size of a mouse hole. According to J.P. Morgan, the share of the U.S. stock market owned by passive funds has surged from virtually zero in the 1990s to over 50% today. But that is just ownership. The terrifying number is trading volume. Passive funds own half the market, but they account for only 5 to 10% of the trading volumes. This means 90% of the trading, the activity that actually determines the price of your retirement account, is done by high-frequency algorithms and active traders who have no loyalty to the asset. When a sell-off begins, these active traders vanish. They are programmed to withdraw liquidity to protect themselves. They step away from the market. The bid, the price someone is willing to pay, disappears. Now imagine the people in the theater smell smoke. Panic sets in. The passive investors who were handcuffed suddenly break their chains. They want out. They hit sell on their 401ks. Millions of sell orders flood the system.
But the active traders, the people who usually buy, are gone. The algorithms have turned off. There are zero buyers. What happens to price when there is infinite supply and zero demand? It does not just go down. It gaps down. It free falls. A stock trading at $100 does not go to $99, then $98. It goes from $100 to $70 in a millisecond. This is the illusion of liquidity. You think your ETF is liquid because you can sell it today, but you can only sell it because net flows are positive. Let us look at the concentration risk. This is the greed component. As of late 2023, the Magnificent Seven tech stocks, Apple, Microsoft, Google, and so on, accounted for nearly 30% of the entire S&P 500 value. This is unprecedented concentration. It is parasitic finance. When you buy the S&P 500, you think you are diversifying. You think you are buying 500 companies. You are not. You are essentially making a leveraged bet on 7 technology companies. If one of them sneezes, your safe, diversified portfolio catches pneumonia. The mechanism of the ETF forces you to buy these expensive stocks. If Apple is overvalued, a rational investor would stop buying it. But an index fund must buy it. It has no choice. It is a mindless robot. It takes your money and buys more of the most expensive thing. This pushes the price higher, which forces the robot to buy even more. This is an engineered bubble. It is a mathematically guaranteed way to disconnect price from reality. Consider the daily trading volume of the SPY ETF, the biggest S&P 500 fund. It often trades $20 to $30 billion per day. But the underlying stocks, the actual pieces of companies inside the box, might not trade with that same velocity relative to their size.
This creates a mismatch. You are trading the wrapper, the ETF, faster than you can trade the contents, the stocks. Michael Burry pointed out that inside the Russell 2000, an index of smaller companies, there are hundreds of stocks with such low trading volume that if the ETF had to sell them to meet redemptions, it would take weeks to unwind the position without crashing the stock to zero. But the ETF promises you daily liquidity. It promises you can get your money out instantly. That promise is a lie. It is a mathematical impossibility in a crisis. Let us talk about the scale. The global ETF industry is closing in on $12 trillion in assets. That is roughly half of the GDP of the United States. If even 5% of that money tries to leave at the same time, the door is too small. The outcome? The ETF price disconnects from the net asset value, NAV. You might see the S&P 500 index at one level, but your ETF is trading 10% lower because nobody wants the wrapper. Or worse, the gate comes down. We saw this with the Michael Burry Big Short scenario in real estate funds, and recently with some REITs, real estate investment trusts. When too many people try to withdraw, the fund manager simply says no. They freeze withdrawals. Imagine logging in to your Vanguard or Fidelity account during a crash, hitting sell, and receiving a notification. Due to market volatility, redemptions are currently suspended. Your money is there. You see the number, but you cannot touch it. You are watching your house burn, and the fire department has turned off the water. This is the big reveal. The market is not a place where we discover the value of companies anymore. It has become a Ponzi scheme of blind flows. The early adopters, boomers, put money in. The prices went up. The late adopters, millennials and Gen Z, are putting money in, paying sky-high prices to cash out the boomers. The only thing keeping the prices up is the assumption that the money will never stop flowing in. But demographics are shifting. Boomers are retiring. They need to sell to pay for health care and living expenses. They are turning from net buyers to net sellers. Who is going to buy their $12 trillion bag? You? If the mechanism of price discovery is dead, then we are flying a plane with no altimeter, in a storm, trusting an autopilot that was designed for clear skies.
The modern financial system is faster than 2008. It is more global, and it is more automated. In 2008, humans were panic selling. In the next crash, it will be algorithms. Algorithms do not have feelings. They do not have hope. They do not hold the line. They execute. When the trend reverses, the same mechanism that drove prices to the moon, that blind, passive, automatic buying, will work in reverse. It will become blind, passive, automatic selling. This is the danger of trusting institutions built on borrowed time. We are living in a state of denial. We believe that because the market has always bounced back, it always will. But markets only bounce back when there are buyers who see value. By destroying price discovery, we have blinded the value investors. We have blinded the very people we need to save us when the crash comes. Michael Burry is not telling you to put your money under a mattress. He is telling you to wake up. He is telling you that average is over. You can no longer afford to be a passive passenger in your own financial life. You cannot outsource your due diligence to a blind robot. The system relies on your ignorance. It relies on you staying asleep, feeding the machine with your bi-weekly paycheck, and not asking questions about liquidity or price discovery. So, I have to ask you, are we wiser now? Or are we just walking the same path as 2008, wearing better suits and using faster apps? If you found value in this deep dive, if you want to arm yourself with knowledge against the coming storm, you know what to do. Share this video with someone who thinks the market is safe. Skepticism is the only shield we have left. Hit that subscribe button, turn on notifications, because the next time the market freezes, you will not want to be the last one to know. I will see you on the other side. Liquidity is a coward.